Good morning or good afternoon, depending on where you're located, and welcome to our fourth annual Energy Storage Conference Virtual Edition, Insurance Products and Their Role in Financing of Energy Storage Projects panel. We thank you for joining us today. All attendees will be muted throughout the duration of this event. If you have any questions, we ask that you please submit them by clicking on the chat icon on the right side of your screen and typing in and submitting your question. Questions will be addressed by our panelists when time allots. And with that, at this time, it is my pleasure to introduce our moderator of this event, Elizabeth Kraus, a partner at K&L Gates out of our Seattle, Washington office. Elizabeth, please begin.
Thanks so much, Grant, for the introduction. Thank you all for joining us this morning. As Grant mentioned, I'm a partner at K&L Gates. I'm in the tax group. I'm also the co-leader of our global power practice, resident in the Seattle office. Thanks everyone for joining us this morning from all over the world. We're really glad that you're able to meet with us today and hear some of the great insights from our panelists today. I'm joined today by Deborah Duss, who is the Global Head of Sustainable Energy with Howden Specialty Limited, which was previously RKH Specialty. Deborah joined Howden Specialty from Swiss Re in October of 2018 with over 15 years of underwriting experience in the energy sector, handling IPPs and utility clients worldwide, with a particular focus on renewables. In 2010, Deborah built Swiss Re's offshore wind operational portfolio from scratch. I'm also joined by Jay Golden. He's the Vice President of Green Tech Solutions for Munich Re America. In this role, he works with energy system manufacturers, developers, and financiers to support solar, wind, energy storage, and bioenergy project development. Prior to Munich Re, Jay led business development at Enphase Energy. Krish Kumar is the CFO of Asvolta. He oversees all financial aspects of the company and manages shareholder and investor relationships and reporting. Krish has over 20 years of experience in treasury and finance in the renewable energy and conventional power sectors. Prior to joining Asvolta, he headed finance and treasury departments at three major independent power companies, NRG, Edison Mission Energy, and Intergen, for over 18 years, where he was responsible for capital raising, project valuation and structuring, treasury operations, audit and compliance, and transaction management. He also served as an energy banker at West LB, where he originated and structured energy project finance transactions. Earlier in his career, he held financial structuring roles at Shell and the Williams Companies. Finally, Hugh McDermott is the Senior Vice President of Sales and Business Development for S Inc. Prior to joining S, Hugh was the Vice President of Sales for Silver Spring Networks, where he successfully led the company's market building presence and key partnership development for smart grid and smart city business across the APAC region. As Global Head of Business Development at Better Place, Hugh created the world's first smart charging commercial offering, which leveraged networked electric vehicle infrastructure to provide dynamic load management and energy storage services to utilities, grid operators, and energy traders. We've got a wealth of experience on this panel, folks from across the industry who really understand finance and who understand insurance and its role in finance, as well as risk management. Just a couple of quick housekeeping items. Of course, Grant mentioned that the chat box is available for Q&A. Please do feel free to insert questions throughout the panel. We will incorporate them into the comments and take any sort of miscellaneous questions at the end. Now then, just to set the scene here, of course, project development and finance are about a lot of things, and energy storage is about a lot of things for that matter. But one of the main things in everyone's mind during these processes is risk. Of course, risk is inherent to the financing process. We have to consider who's going to bear it, where it's going to come from, how to mitigate it. Insurance, of course, is all about evaluating and mitigating risk, which is why it can be an important tool in many areas, not least of which is energy storage and other sort of earlier stage and interesting technology areas. But let's set the frame for everyone here. Krish, how do you evaluate the financial viability of an energy storage project?
Sure. So just for those of you who don't know, Asvolta, we're a pure play IPP and energy storage space, focusing on standalone energy storage, lithium-ion technology. So when it comes to energy storage, right, there's a lot of transformations taking place from 5 years ago when there are a lot of test level projects, or there's 1 megawatt project connected to a wind project or a solar project, and now we are seeing a transformational change in the space with larger standalone applications in an energy storage space. The first thing comes to mind is when you talk about financial viability, and is the cash flows. How stable are your cash flows? Is your cash flows fully contracted? The nature of the energy storage. A lot of our projects are in California because California has been in the forefront of energy storage. Your cash flows are broken into, there's a capacity only contract with utilities, and there is uncontracted revenues coming from Cal ISO because energy storage projects provide essential grid stability services, ancillary services to the market, like what we call as regulation services and spinning reserves, most notably those two products. The financial viability is how reliable are those cash flows. The contracted cash flows, of course, if you maintain the project as under the contract, you get paid.
We're all still live.
Yeah. Hugh, while we wait for Chris to get back online, can you just jump in? Do you have anything to add? I mean, obviously cash flows are important and stability of cash flows is important. What else do you all think about when you're considering the viability of an energy storage project?
Yeah, so for those of you who are not familiar with ESS, we're a flow battery technology provider, first off. So we're sort of on the receiving end of what makes a project financially viable from the investors and the developers. And so one of the topics that comes up frequently around our particular technology is the warranty. Being a newer technology, one with less of a track record, how strong is that warranty? What does it cover? Those kinds of aspects are vitally important to the financial viability. It's often kind of the first question that comes out of our customer's mouth. In fact, fortunately, we have Munich RE in our corner, and this is an unpaid testimonial, but we don't get very far in those conversations if we didn't have them backstopping our warranty. So we're unique in one aspect in that our warranty also goes beyond the technology itself. It also provides business continuity coverage. So your warranty is only as good as the company is around to that. So but we have a reconnect here.
Yeah, sorry. Go ahead, Hugh. I'll message Chris separately.
Okay. So that business continuity warranty is something that further supports the technology decision that investors and developers of energy storage projects are concerned with. It's great that we have a 10-year warranty on our battery modules, but there's also the option to provide additional project cover in the event that ESS goes out of business or is insolvent at some point during that warranty coverage period. So, what that does ultimately is it provides the comfort to customers, but it also provides implicitly a backstop or a protection to our balance sheet, which is really fundamental to project financial viability.
Can you guys hear me okay now? Yes?
Yes, we can.
Okay, sorry. I think I was talking to myself. The disadvantages of remote conferencing, I guess. Sorry about that. So no, basically what I was saying was the first part of the financial viability that we look at. I mean, a lot of our energy storage projects are California centered because California has been on the forefront of energy storage, and the contractual structure is usually a contractor cash flows with the utility under a capacity contract, and then there's additional layer of uncontracted cash flows coming from Cal ISO market, where energy storage provides essential grid stability services, ancillary services to the grid, like what we call as regulation services and spinning reserves are most notable products. So when you look at the financial viability of an energy storage project, you look at, you start with the cash flows, right? The stability of the cash flows. And of course, the contracted cash flows are, stable in nature. The uncontracted cash flows takes a lot of, time and effort to understand it and take in, look at the outlook and the future and how it pencils out. And then the second part is really the technology part, the choice of technology and how reliable it is, whether you can have independent engineers vouch for it as a commercially proven technology. So you can have investors support it, not only equity investors, but also more like a traditional project finance type lenders support it to make the project more viable. Because if you get more and more mainstream investors into your project, you're lowering the cost of capital, which directly goes into the question of financial viability of the project, right? The third is the insurance part, which I know is the central part of this conference, is the risks associated with the project, which is the inherent nature of energy storage, having fire risk and environmental aspects that is something needs to be studied. Support policies the way the investors would like to sign off on it. There's been a lot of learning but a lot of maturity has taken place in the industry. The insurance companies are very proactive, as much as the banks have been. I would say 3 years ago when I started before I joined ES Volta, there was a lot of hesitation on the investors, the insurance and insurers and the banks wanting to come into energy storage, but wanting to learn, not really actually doing it. But now we're at the phase where actually all of these players, the stakeholders in the industry, are actually doing it. So that's quite a transformation in my mind in the last 2 to 3 years. So the financial viability of projects is not as much of a question as a black box as it was 3 years ago, but it's still an interesting one to solve. And I would say, that it's not as simple as energy storage projects are not as simple as like solar projects. There's a lot of pieces to it, especially the risks, the technology part. Understanding it is quite important. So let me stop there and have other panelists join.
Yeah, thank you for that. I think while you were offline, Hugh was telling us a little bit about how ESS approaches financial viability. Of course, they're a manufacturer of batteries, and he was discussing, of course, that the warranty conversation is very important for them. As a developer, is it a different conversation for ES Volta?
No, it's the same. For warranty is a central part of how engineers view it and give comfort around it. And also, there's a lot of question about the longevity of the projects, the technology. Is it 20 years? Is it 25 years? Is it 30 years? And we've been through the same thing in the wind space and solar space, if you all remember 10, 15 years ago, right? 15 years ago, we were pushing the
It looks like we've lost Krish again. Well, let's, Hugh, did you have anything to
I haven't
add?
seen.
Mhm. Yeah. So thanks for that, Krish. Hugh, did you have anything to add to your earlier comments about warranty? Any other big issues that you all consider when you're considering the financial viability?
Well, I guess the fact that our warranty takes technology out to 10 years is one aspect. As Krish was mentioning, most developers today are looking for 20 to even 30-year type projects for energy storage to align with PPAs on renewable projects. And as of today, at least our warranties don't go out that far, or at least what we've been able to procure. Interesting phenomenon is, while we get some queries around, can you provide warranties out that long? The interesting aspect is when you get really into the further discussions, they're not actually asking for warranty. And the analogy I'd use here is kind of like a diesel genset. You can get your warranty on a diesel genset 5 years, 10 years. Everyone knows that properly maintained, you can get decades of use out of that equipment. And the analogy is very apt, even if it's a poorly fossil fuel based analogy to our technology, that the flow battery technology does last for decades, and with proper maintenance, that warranty issue actually is not really that relevant after your initial 10-year period or so. The 10 years is really aligned to cover typical debt terms, and that's really to protect the investors.
That makes a lot of sense. So I think, we've talked about a little bit about some of the evaluations and some of the tools in the toolbox, but of course, insurers are all in the business of evaluating reward as well as their potential risk, right, that they're covering in the policy. Some are obvious, right? Like, for example, that a battery technology will cause fire, but a lot of things aren't. Jay, you spend a lot of time on this topic. What are some of the primary risks that Munich Re has spotted in the energy storage market and energy storage projects?
Thank you, Elizabeth, and thank you for hosting this panel and pulling together such a great set of co-presenters. So very briefly, so I'm with Munich Re, as you say, and part of a specialty group that covers renewable energy technologies. And I spend the majority of my time on energy storage. I like the way Chris lays it out. He's looking at cash flows of a project, and he's looking at how much is contracted. And we, from the insurance side, are looking at what are the risks to those cash flows, both positive and negative. So if you have a decrease of revenue because you have less availability, or you have an increase of cost because your maintenance cost went out of the expected bounds. Perhaps there's a slide teed up. Grant, I don't know, do you have that control? I'm hearing it. I'm hearing it.
You want me to put up the slides?
Yes, please. And I'm hearing an echo. Is anybody else catching that? All right. So here's some of the risks that we look at. And so an insurance company is a product company, just like a manufacturer is making different products. We have different products aimed at the separate types of risks. So we can look at the risk of the performance. We can look at the risk of chemical degradation. We can look at regulatory risk, which we don't have a coverage structure for. You have other risks at the bottom of cyber and pandemic. The pandemic risk wasn't one that a lot of people were planning on and considering in their procurement or their delivery for this year. But clearly that's the black swan that has come to all of us. So I'd welcome questions about any of these risk structures and talk to people about how we can help.
Thanks, Jay. Deborah, do you have anything to add to that? Obviously, as in your role focusing on storage and renewable energy, these are things that you also think quite a bit about. I don't know, Grant, you could probably take that slide down so that we can see the panelists.
Mm-hmm. Yeah, actually very nicely covered by our panelists. For example, the warranty is another sort of an insurance instrument. Let's call it that way. So important is that we have a holistic view on the entire risk management. Warranties and insurance is one way of doing risk management. And therefore, it's very important that those discussions happen early, way before the project is kicked off, before construction starts, and the various puzzle pieces are actually put together, because a comprehensive warranty cover should reduce your need for insurance purchase behavior. So that is all to be considered in interaction with each other. And there are certain basic requirements, as Hawk mentioned before, to make insurers comfortable with your risk. So you need to achieve the basic, but then it's about where you find the best sweet spot in terms of managing your risk.
Thank you. First, Krish, Hugh, do you have anything to add on this point? Sorry, Krish, I think you're muted. Were you trying to say something?
Right. So I'll jump in if Krish, I don't know if you had a comment there, but in terms of some of the risks that Jay's outlined, I think we've got some inherent advantages over some of the other technologies just by the nature of the chemistry that we use. It's an iron and salt water battery, so inherently we don't have any chemical, fire, or contamination risk. It's not going to blow up. Uniquely to the particular battery chemistry we have, it also likes to operate in high temperatures, so we don't have any thermal buildup or additional ancillary equipment that might fail that could lead to a cascade event on the battery, because we don't need air conditioning up to 120, 125 degree operating temperatures or ambience. But I also say there's one other type of risk that Jay's slide pointed to, the regulatory risk. It's a regulatory / market risk. The fact that you've got a battery that doesn't degrade with operation, that it's indifferent to the type of duty cycle. You're not at risk of voiding a warranty. You're not at risk of prematurely aging the battery by changing market conditions, changing duty cycles, or achieving the holy grail of energy storage, which is revenue stacking. And now you want to put all kinds of different cycles on top of this battery, many of which you can't do in today's markets. But I think we all see the signs of change coming, and that the industry is pushing for, being able to have a battery that could operate and provide multiple different services to stabilize revenues, give more surety around the revenue stream for financeability and obviously for achieving returns. A flow battery inherently provides that, and so de-risking a project, or to put it in the positive as Jay characterized it, that flexibility around the operating and duty cycle and the long life of that battery gives you an advantage in that regard.
Elizabeth, can you hear me okay now?
Yes, perfectly.
Okay, finally. Sorry about that.
Thank you.
Yeah, from a developer standpoint, I mean, I would break it down into performance risk, which is Hugh touched on, and Jay talked about it. Deborah talked about it a little bit too. Sorry, I couldn't jump in earlier minutes. So performance risk is really like if the adoption of technology is relatively new, and is there a warranty behind it? Does warranty sufficiently cover it, or the warranty provider does have balance sheet? And that's where the insurance companies play a great role in providing a performance warranty behind that, to give lenders a comfort of it's more of a credit enhancement or giving more certainty. Of course, it costs us more, but it also changes. If it changes the answer from getting capital, not getting capital, to getting capital, it's a very important risk to cover and buy performance risk warranty insurance from the insurers. And then the second is the usual reasons why we get insurance for is the catastrophe type risk, like fire comes to mind when you talk about lithium ion. And if you're in the flood zone, earthquake in California. A lot of our projects are in California, so we often think about earthquake, which is not easily insurable, but we make sure that the buildings are up to the seismic code. Some of the warehouses that we look to rent are actually one of the projects that we look to rent. The building was built in World War I era, and I didn't even know such the old buildings existed. We found out that the upgrades needed to meet the seismic code isn't even worth it. So we had to actually abandon that development project for that. We had a very good utility contract, but for, you asked about financial viability. This turned out to be not as viable as we thought, and we couldn't find alternate site in California. It's very difficult to do siting in California, so we decided to forego the utility contract. So, those are real risks we deal with from, like a natural catastrophe risk list of risks that I just went through. So we look at it, from a technology performance standpoint, what risks we're taking, and then the natural catastrophe standpoint. And the third is the new one that's unique to energy storage is the cybersecurity risk that we have to evaluate. Everybody knows there's a presidential order on bulk order supply, and making sure that the the major like transformers and the inverters are not from adversarial countries that could eventually, sabotage the grid in some fashion. There's valid risks. Keeping politics aside, that's not the focus of this panel. It's really, about the energy storage industry and the grid stability factors. There's a lot to, look into that. And so the cybersecurity is one of the things that we look at very carefully. Because software is an essential component to energy storage. So I would add that to the list of the risks that you would have to evaluate.
Thanks for that. That's all super insightful. Sounds like, we've talked a lot about what the various risks are and how to evaluate them, which I think is a really great way to set the stage for the meat of our discussion here, right? And that is how insurance can actually address some of these risks. Krish, as you mentioned, right, sometimes for a project, it just doesn't pencil because it's too expensive, frankly, to even get started, to even get to notice to proceed. But, a lot of those costs these days can be addressed by insurance. As you mentioned earlier, there's been a surge in insurance product coverage in the energy storage industry over the last couple of years. And so let's turn now to, what can insurance actually do here? How does insurance come into play in risk management, specifically in energy storage? Deborah, could you get us started on this topic, please?
Yeah, with pleasure. Hopefully, insurance was into play very early. So we had the luxury that we had an insurance market that was very gentle, and capacity was always available. So there wasn't an emergent need to address insurance too early in the stage. That has meanwhile changed a bit due to the overall loss experience we faced in the renewable space, but with batteries in particular, the fires were named before. So that's a bit the game changer and forces us all to sit early on the table and do a risk management landscape. Insurance is one part of it, as I mentioned it. Hopefully, we have a good snapshot of what the warranty and the service agreements are covering, and that would allow us to not overbuy insurance, because often that is the challenge, that various parties are involved. Someone is buying the warranty, someone the service agreement, and another party is in charge of the insurance, and those puzzle pieces are not matching together. So this is like the groundwork that has to be done. And then we have gladly, besides the traditional insurance placement, companies like Munich Re that bring in more exotic products that allow developers to protect their balance sheet. And as we heard, batteries just started their story and their ownership in terms of grid stabilization. So we will see massive spikes in regards to the revenue you can produce with those batteries. And it will be exciting to see what the insurance world is providing in terms of those revenue protection coverage. The performance coverage is one element that could be very interesting. Just link it to the PGM market, for example, where we've seen what penalty could actually mean in terms of lost revenue.
Thank you for that. I think, Jay, you have a slide that I think really breaks this down pretty well in terms of what the various kinds of insurance are. Grant, would you mind throwing up Jay's second slide, please, so that he can go through it?
Thank you, Elizabeth. Thank you. So insurance is, everybody has a different view on it, and all of the players in the chain, whether you're a manufacturer on the left through to the off-taker or utility on the right, you all have a different need, and you're all going to have different insurance structures. So, and as Deborah pointed out, they all need to fit together. So if you're contracting with somebody, they're going to ask you to hold certain insurance, and you're going to ask your providers to have other insurance. So the classic insurance on towards the bottom of the slide is property insurance. So is the property at risk from natural catastrophe or fire or do you have a property risk there? In addition to that property risk, you might have the liability exposure to adjacent properties. So today, energy storage is typically being built in conjunction with solar projects, and the energy storage will be packaged into that solar project's property insurance. When it's behind a fence, that's achievable. If you have standalone energy storage projects, and I'm curious how Krish has solved this, I'm hearing from some classic insurance companies that there's limited capacity available to cover just an energy storage project, especially if it's in a commercial building. So that's the classic property insurance. And that's typically held by the site host or the utility or the owner of the project. On the left side, you'll have the manufacturer will have product liability insurance, they'll have general liability insurance. What Hugh and I have been working on for a couple of years now is this warranty insurance and performance insurance. And once you actually have built the product and sold it, you have to get it there. So I've categorized it as transport insurance. So that could be marine, inland marine, or marine insurance. All in all, there's lots of layers of insurance. And Munich Re is a insurance company with products and operating companies and subsidiaries that can cover many of these. But all of you need an insurance broker like Deborah, or the global giants, or Marsh and Aon and Willis. But you need an insurance broker like Deborah, who is a specialist in the business, who can understand which risks you're taking and which risks are better left to your counterparts. So who's holding which risks? This was what Elizabeth was saying. And then who needs to cover it off? Glad to answer questions further. I do want to add one thing that he was talking about, revenue stacking. So revenue stacking is great. It should help pay for energy storage systems faster if you can do it. But you also have to think of revenue stacking as risk stacking. So each of those revenues has a liability in terms of an obligation you're signing up to, or it may wear out the battery faster. So you have to contemplate, and we have to contemplate the usage pattern of the system when it's built and when the usage changed. So thanks. I'm glad to answer any further questions.
Yeah, thanks for that, Jay. We actually just had a question come in about professional liability insurance to cover design and O&M. How does that come into play in this topic?
So it's a great question. So we also have this category of liability insurance that could be with engineering firms, or your lawyers have their own insurance. Even insurance brokers have liability insurance. So everybody who is giving guidance and making a reputation and putting a stamp on it, they're taking some obligation that they're doing it right. So let's first talk about the liability of the designers. They have an obligation. The engineers have an obligation to follow the specifications the designers have. We've reviewed a energy system. It's not an energy storage, where they put the conductors, the main electrical bus, underneath another key part of the project. They pinched one of the wires. They didn't size it right. It caught on fire, and it wasn't the owner's problem. It was actually the engineer's problem, the EPC, who did it wrong. So you have to attribute you have to find the fault and who was responsible for it. And it would there be under the EPC's insurance, not under the owner's insurance. The question also asked about O&M. O&M is, they do have liability, but fundamentally, we look at O&M as a really important piece of the puzzle. Some of the energy storage systems require maintenance in order to keep working, to keep the warranty in place. They need to be tested regularly. That's part of the operations. And if you don't do the O&M, you may be voiding your warranty. Just as if you don't rotate the tires on your car, you void the warranty on your tires. It's the same idea. So think about O&M, and as Krish pointed out, certainly software is a source of risk, and software malfunction could cause all of the other risks to happen all at once.
So, there are a lot of different kinds of coverage here, but I think one of the questions that I have is when do these various coverages make sense? Obviously, Hugh is a big fan of warranty insurance. He pointed out earlier that it's really helpful in discussions with customers because ESS is doing something a little bit different than a lot of other people are doing. When do these others make sense, though? And when do they not?
It's great. So you have to think of these projects in the life cycle of the project. So clearly, simply, the transport insurance is not so important 3 years into the project after it's already been built, or the construction period is already ended. So you will need insurance at each of the steps. You want to think about when is it relevant and what's the appropriate tenor for that insurance. So property insurance, like your car or your home policy, are annual policies. So you're going to buy the insurance each year based on your need at that point. And the warranty and performance insurance might be something you contract for that covers the tenor of the warranty. So if it's a 5-year performance contract you sign up in the PJM market, or a 10-year warranty, then you want to get that insurance up front, covering the length of the obligation. That make sense?
Yeah, it does. I guess what I'm trying to get at, though, a little bit more is sort of the business case, right? Like Hugh, and maybe Hugh or Chris should really jump in here, frankly. For warranty insurance, right, it makes a lot of sense when the company is young or when the technology is young or what have you. Obviously, constructional risk is pretty self-explanatory. But when, for example, would pollution liability insurance make sense for a company? Chris, Hugh, do you have any thoughts on either one on that question?
Yeah, like Jay mentioned, the insurance market is still evolving, and it's certainly matured, like I said, compared to 3 years ago, but it still has long ways to go, especially for standalone energy storage. And there's a handful of players, insurance players willing to do it. There's more joining the group, but we're not, at a place where it's easily commercially available. I'm not talking about property casualty. I'm talking more like pollution liability, to answer your question specifically. The pollution, you can break it into two types of pollution liability, right? That's accidental pollution, that something happened and without your knowledge, and that's insurable. But whereas the other one that, if there's a pollution over a period of time, like say a year or two, something has been happening and, you knew about it or you didn't know about it, but it's been happening for a long period of time, and that causes environmental damage. That's certainly not commercially feasible today. So that's one of the things that we have to push back on utilities and other off-takers or other stakeholders and saying, look, this is not commercially available, so we can't procure it, so you can't require us to get it. Does that make sense?
Yeah, it does make sense.
It's a very valid point, Trish, if I can add to that. As we see the insurance market changing, this is one of the biggest threats that you have contract negotiations in an environment where insurance was available, and then a few years later, when they come into play, the insurance market is no longer providing that coverage. And the yearly discussions with all involved parties is so important, because insurance isn't the one-way street solution. You have also to look into the warranty and contractual setups. Absolutely.
No, that's very important. Yeah.
Yeah, I would just echo what Deborah just said. We most commonly find ourselves on the OEM spectrum. That's where we prefer to be in terms of the spectrum that the slide depicts there. But we do have a couple of projects where, by circumstance more than desire, we found ourselves as the integrator, developer of projects. And when we're the prime contractor, property insurance, pollution liability insurance, those are standard terms in those contracts, as I'm sure they are with any EPC contract that we usually don't see as an equipment supplier when we're in the equipment supply role. But the pollution liability and property insurance, fortunately, those terms are usually laid out by the customer, getting our insurance partner involved right from day one on understanding and making sure we have all aspects of that covered has been crucial to our successful negotiation of those contracts and making sure we have the appropriate covers for the durations needed. So that we're not exposing our company in the case of being a prime contractor there. So I think if there's a perspective here, it's bringing in your insurance partner in from day one on those contracts.
We have a somewhat related question here from one of the attendees. The question is, what percentage of the overall project cost, or CapEx, should be allocated for different types of insurance that are presented here? That's probably closest. Go ahead.
Sure. Can you guys hear me? I just want to double check.
Yes. Yes.
Yeah, sure. No, that's a good question. So we look at it, I think insurers can speak to it much more intelligently than I can. I think they look at it on a replacement cost basis, right? Something happens, what part of the total project needs to be replaced? That's essentially the battery system itself and the integral, pieces like transformers and other things to go with it. And then the question is your energy storage inside the building or a container system? If it's on a container system, it's quite far from, your interconnection. And so those things go into that calculation. I would say roughly 80 to 85% of the total project cost. It turns out to be the replacement value, but again, it depends on the design and what's integral to the battery system project, specifically to the project, and the insurers usually look into it. I'll defer to the experts more about this one.
What is always helpful is to look at the entire CapEx and OpEx cost involved for a project, and insurance is part of that. So that can hugely vary based on, as Chris said, the location specific parameters. For example, is it in a flood zone? What are the protection measurements? But also how much does the warranty take ownership? So that will have a huge impact on the calculation for machinery breakdown, for example. What is the experience with fires for that particular type of battery? What's the operation and maintenance experience? So there are multiple factors, and I would say the easiest assessment for involved cost will be what are the essential must-have to make insurers comfortable with your project. So those tick boxes need to be fulfilled to get insurance. And then you have certain soft factors that will influence your premium level.
Yeah, I'd like to come back to the performance insurance for a moment on that aspect, because I think there's some changes afoot in the market. The standard performance requirements for energy storage to date have been principally around power and energy capacity. But we're increasingly starting to see, with the emergence of different models like energy storage as a service or tolling models, availability starts becoming critical to that type of insurance, performance insurance. Round trip efficiencies start becoming critical to performance guarantees. That to me is kind of the leading edge right now, and that maybe could be an open question to the rest of the panelists here, what they're seeing and experiencing in that regard. We've been approached by a number of developers around that. We don't have a product or an offering sufficiently developed that we can provide guarantees around those latter two parameters yet, but that's something that we see is going to become a necessity in the very near future, based on the types of opportunities and deals that are coming into the market, particularly in California.
If I can pile on that, we see inquiries in California, in the East Coast, in Germany and Australia, and each of the utilities structures or the ISO structures has a different product that they're looking for and a different commitment that they're looking for. So the developers who are working across these geographies, I'm sure this is a familiar thing. You're being asked to give a performance guarantee with liquidated damages if you fall over on one of the metrics. We're working on generalizable structures that are relevant for different pieces of the puzzle. Some of the obligations should fit on the integrated system role, because it's not just the battery, it's the inverter and the software that determines how basically availability and uptime. The battery degrades gracefully, we hope, the inverters or power conversion systems are a little bit more binary, and then you have to look at what the topology of the system is. All said, some also might be on the back of the project owners. So in the thermal generation, there's a product called generator forced outage, where if the grid calls for an emergency and you happen to be down at that time, it's a severe penalty to the thermal generation station. That type of structure will move into peak pricing events for energy storage, and the energy storage developers will either look at the outage called by the utility, or in Texas on a hot day, the power is extremely valuable. Being out on an afternoon in August is much more painful than being out on a morning in February. Deborah, I think you might have worked with some of those generator forced outage products, and you can think about how it moves from thermal generation over to energy storage.
Mm-hmm. I hope we can implement the lessons learned from the generator sector. What is unique with batteries is that the involved revenue stream will most probably relocate the property damage value of a project. Because as you said, with those markets, PGM, where you have huge spikes in terms of the power price, and I mean, the batteries will be paid on their availability and the frequency availability, right? That will be interesting how that changes the insurance world for battery, because this will be the #1 profit contributor, whether you can act in the grid stabilization process as a battery operator, right? And when it comes to claims management, I think one interesting consideration will be on what do we relay? Do we relay on the warranty contract, where the specification was made in terms of maximum parameters a battery should be run? Or do we relay on the operation and maintenance approach? These are all questions that have to be considered, especially as we won't have historical data.
That's really interesting. And I think, sort of building on that topic, right, there's a lot of different things that are going on these days with energy storage, and insurance is a key aspect of that. Where do you think this is going? Where is insurance coverage going for energy storage? We've had some splashy stories about fires recently, and that makes everyone nervous, right? And particularly when it comes to performance assurance, is there any chance that we might see longer terms for those kinds of policies?
I do think as the technology is proven, the terms can get longer. So in the solar market, we provide 20 and 25 and 30-year warranty backstops, because those are more proven technologies. For energy storage, the warranty durations can change as we learn more. Your question about how is the market changing for storage insurance, I think the safety aspects and fire and property insurance, that will get easier over time as standards come into play, and as manufacturers comply with UL standards or IEC standards or NFPA standards for the integration. So that should get easier and better, and insurance for a somewhat dangerous, somewhat explosive energy storage system should be comparable to an insurance for a somewhat dangerous moving vehicle, but you've improved that insurance, or you've improved the safety by putting in adequate brakes, you've doubled up with anti-lock brakes, you've tripled up with seatbelts, you've quadrupled up with airbags. So the equivalent of airbags, seatbelts, and anti-lock brakes for energy storage will be good fault detection, good mitigation, and good predictive maintenance.
Yeah, can answer that. I would expect two types of insurance outcome for the parties that are transparent and communicate openly what the project is all about and what contracts were negotiated. There is a really great opportunity to get insurance as a tool of investing into future projects and having a capital release. whereas others that are struggle to have the common understanding of where the risk exposure lies and bring together all the necessary information will truly struggle to get the insurance coverage in place.
Can you guys hear me? Okay. Yeah, from a developer standpoint, yeah, speak to both what Jay and Deborah said. So like I mentioned, we have a couple of projects. One project is operating more than 3.5 years in Irvine, California, that was put in place in response to Aliso Canyon fire risk RFP back 5 years ago. And one in Canada, Ontario, Canada, a larger project called Stratford that's operating close to 3 years now. So we having, obviously we have insurance, right? So like Deborah said, we have been very forthcoming with insurers, explaining to them how our technology works, what are the mitigants we are continuing to put in place. Jay mentioned, a great analogy to car industry, right? One of the things that I would add to Jay's list is the fire suppression. And how do we, do first responders know what to do when they come in? And is there a fire suppression built into the battery system? So we made a very detailed technical deep dive with the insurers, make them understand what we know, what we don't know, what we can control and what we cannot control. And we've been very forthcoming with that. And plus we have operating history. So that has, Elizabeth, going back to your question is how is it, going to be in the future, right? So insurance are more and more accepting this risk and actually wanting to do it. We're in the market right now extending our coverage. We've seen much greater interest this year compared to last year from a group of insurers joining our portfolio of projects. So it's both ways. Like Deborah, I think, hit it perfectly. It's how willing are we to explain and understand and parse out the ones that we have good safety measures in place and how we control it, the ones we can't control, and then that help insurers make the decisions and help us insure the projects, right? So that's a give and take.
So you really built a trust, Chris, huh, with the insurers. You did.
I'm not speaking highly of myself. I'm just telling you what we are trying to do. That's all.
Just out of curiosity, how much of your work would you dedicate to insurance at the moment, in percentage, roughly?
A lot. Do I like it? That's a different question. No, I like it in the sense it's not something you always think about, right, as a CFO, because you got capital raising, you got other things ahead of insurance, but it's a very important component. Yes, we're spending more time than I would like to, but the more time I spend it, I'm starting to like it because I learn more about our own projects myself and help insurers understand it. So that's something we take it seriously.
If I can add, people think about insurance as sort of the downside protection, and it is certainly a way to think of insurance. It's protecting your balance sheet. It's taking care of the downside. You can also think of it as the upside. So it as an enabler of your business, as Deborah pointed out. So in the manufacturer's case, like Hugh's case, because he has it, he can make an investment grade promise to his customers. So his customers can then lever up on the project. If you are a project owner and you're able to secure assurance that you have a better cash flow, then you can attract more or better financing. So you have to think of it both as oh no, I took care of the case which I don't want to happen, but you also think of it as an enabler for growth and capital relief, and it should be a win-win-win. So your customers, yourself, and the insurance company all should benefit. And nobody wants things to go wrong, but we're here to help if it does. I sound like, I don't know if that's Farmers or Allstate, but we're here.
Couldn't have been better said. I was about to make the same point, Jay, that for us, it's absolutely the enabler. As a new technology coming onto the scene, it's hard to break through. and having the insurance gets us in the game that we wouldn't otherwise be there, and it compresses our business growth. We're able to accelerate that. But I can't resist also commenting on fire risk. While we all want a safe industry because it's good for all of us, that fire risk in our case is one of our main differentiating points, being a water-based battery. I mean, worst case scenario is you have a spill, but in our case, it's a power wash cleanup. There's no environmental liability around that, so there's some other aspects around it that go above and beyond having the warranty insurance coverage that we have. Just the inherent aspects of the technology also help to de-risk it.
I think that's really helpful discussion. Obviously, as the lawyer in the room, we see all of the various aspects of this come down when we're actually trying to get a project done. And it's very rare to see any projects go forward when there isn't substantial insurance coverage involved somewhere, somehow. For example, as Hugh said, that's really what gets you in the door. It's not the end of the story, of course, but it does help a lot for performance assurance and also for, frankly, security of cash flows, which is very important to investors. Very, very important, even if they're only in for the tax credits. And so I think,
I may finish this. Deborah asked a very interesting question. How much time do you spend on insurance, right? So in the past, the technologies or projects like when you say past, like solar, wind, much more mature, right? Or thermal. Insurance is like sort of foregone conclusion. Okay, we just go apply, we pay the premium, we get a policy, we're done, right? So it's like it's taken for granted. But in energy storage, it's not, right? So that's why that's the biggest difference. I would leave the audience with is you have to work proactively, explain what you do and how you do things to help insurers to help you. That's the biggest difference I see between the other well accepted type of projects versus energy storage. Sorry, back to you.
Well, on that thought, I think that's actually a great way to sort of close us out. Thank you, everyone, for joining us this morning, this afternoon, wherever you are. Obviously, nightfall is falling for Deborah in London. Krish, Jay, Deborah, Hugh, great insights. Thank you so much for sharing your thoughts and comments. And with that, I will hand it over to Grant to close us out.
Thanks, Elizabeth, and thanks for moderating today's panel. And again, just to echo what Elizabeth said, thanks to our esteemed panelists for delivering such an informative and interesting presentation and discussion today. And we want to thank everyone in the audience for joining today. We hope you enjoyed. And with that, this concludes today's program. We hope that you enjoyed again and have a great day, and you may now disconnect.